In today's video, we're going to talk about one of the most common investment questions that I hear. And that question is, should I wait for a better time to invest? People want to know when to get in, when to get out, and what to do when markets become or feel uncertain. And that's all wrapped up in one idea, which is timing the market. Today, we're going to talk about the truth behind it and why it typically hurts people more than it helps. Timing the market is trying to predict when the best time is to put money into the market and when to pull it back out. And that sounds great in theory, but in reality, it assumes that you can constantly predict the future. And no one can do that. Not professionals, not institutions, not the media, not anyone. Markets moved based on millions of decisions, global events, emotion, and randomness. By the time something feels safe, typically those prices have already gone up. People typically try to time the market for one reason, and that's about fear. Fear of losing money, fear of buying at the wrong time, fear of regret, and that's all human. Most investors don't miss out because they chose bad investments. They miss out because they stayed on the sidelines for too long or chose to be on the sidelines at the wrong time. So let's just say you wait for the perfect time to invest. While you wait, your cash isn't growing, it's losing money to inflation, and the market is quietly moving forward without you. Historically speaking, some of the best days in the market come after some of the worst drops. And if you're out of the market during the scary times, you often miss the recovery. Missing just a few strong days can drastically reduce your long-term returns. Here's the real truth. It's not about when you invest. It's about how long you stay invested. Long-term investors typically win because they let compounding do the heavy lifting. They stay disciplined during uncertainty, and they don't react emotionally to short-term noise. Wealth is built through consistency, not prediction. As the common adage goes, time in the market beats timing the market. So instead of trying to guess the future, do things that are in your control. Invest consistently. Stick to your plan. Stay diversified. Rebalance when needed. And most importantly, don't let emotions drive your decisions. You don't need perfect timing. You just need a process that you can stick with when times feel uncertain. The biggest risk isn't investing at the wrong time. The biggest risk is never getting started or constantly stopping. You don't build wealth by predicting markets. You build it by staying committed when others panic. If you like videos like this and would like to continue learning more, please consider liking and subscribing. Thank you for watching and take care.